Cost of land may be the leading reason keeping majority of working Kenyans from owning a home. Research conducted by Equity Bank indicates that the cost of land contributes upwards of 40% to the cost of houses, pushing prices up and making mortgages unviable for many people. The bank wants the issue addressed and says that it has a strategy in place to penetrate to the lower end of the market with mortgage products. It was only last year that the central bank released shocking statistics that the country has a paltry 15,000 people servicing a loan as at the end of July 2010.
An analysis of the structure of a mortgage in Kenya commissioned by Equity Bank reveals an unusual composition, with the cost of land taking up a disproportionate 40% of total cost rather than the usual 20 to 30% by far inflating the price of property and locking out many people and by extension borrowers.
The biggest constraint is in supply, developing and getting affordable land. I think the issue of affordability of mortgages have nothing to do with the interest rate. It is everything to do with the cost of land. The cost of land is now constituting 40% of the mortgage value. So when you are in such a situation, until we deal with that issue, then mortgages will continue to be very expensive.
Equity says it has nearly 11 billion shillings earmarked for mortgages, but has been unable to do it so far due to the land challenges. The chief executive wants the issue of land addressed to make mortgages accessible to more Kenyans.
And that almost guarantees anybody earning 20,000 should be able to afford a decent housing.
The bank says that it plans to replicate its mass market model that spurred its banking success in the mortgage sector.
I think the partnership we have with Housing Finance, British American and now Equity Bank will significantly tilt the mortgage market in this country.
Upon access to affordable land, the bank says that it could easily raise long-term financing through the Nairobi Stock Exchange, including flotation of a 30-year bond in the footsteps of the central bank that only last month floated a 30-year savings development bond.
Capital markets regulation